Welcome everyone to the Arnott Opportunities Strategy January 2021 review and update. Thanks for joining us this morning. I'm joined by Yianni and I'm going to run through a few things this morning. First of all, a disclaimer: this document has been prepared for general information purposes only. Persons should rely solely upon their own investigations in respect of the subject matter discussed in this document, and past performance information given in this document is given for illustrative purposes only and should not be relied upon and it is not an indication of future performance. We've got some more detailed disclaimers for different jurisdictions that, if they're applicable to you, I encourage you to read. There'll be a presentation that can be mailed out afterwards. Today we're going to cover a review of our asymmetric investment process, cover some lessons learned and performance summary for 2020, a review of our process. Then we're going to have a look at some of the risks and opportunities we see in the macro environment for 21 and our current themes we have on that we expect to run through 21. Just a little bit of housekeeping. We run one strategy, but we run it across two funds. Those funds are the Arnott Opportunities Cayman Fund, which is US dollar denominated, and the Arnott Opportunities Unit Trust, which is Aussie dollar denominated. All discussion in this presentation is going to reference performance data for the Arnott Opportunities Cayman Fund. Just for the record, the performance in 2020 was pretty similar between the two funds, very similar between the two funds. So let me start with a review of our asymmetric investment approach. What is asymmetric investing to us? It's about producing above average returns with below average drawdowns. And to do that, we reckon you need to find good investments and not lose money along the way of realising those good investments. How do we go about doing that? Our asymmetric approach is a four-pronged approach. The first thing we do is that we find asymmetric themes. Second thing we do is we invest within best stocks in those themes. We always keep an eye on macro for both risks and opportunities to generate an asymmetric return payoff. And that's exactly what we've done since '99. We often hear in the market, we're going to hear it today following last night's moves, the markets are very volatile. We don't actually mean the markets are very volatile. We actually mean the markets are going down a lot. And as an asymmetric investor, and I would argue as an investor broadly, we don't get upset with upside volatility. And implicitly, as part of our asymmetric strategy, we are trying to generate upside volatility. We just ignore these early returns here. We were using a lot of leverage back in those days, and we're not going to be able to repeat those type of upside returns. These are quarterly returns. But what you can see here is spike in returns. When things are going well, when all our themes go well, then we have high returns. On the downside, we have very few drawdowns, and that is at the heart of producing an asymmetric return profile. It also probably, I think, concisely states what we think is our competitive advantage, is that over a very long period of time, we've found, invested, and delivered an asymmetric return profile. Just to look at that in the numbers, since 2013, we delivered over 20%, versus the MSCI World Index around 8%. And importantly, and as very much part of our strategy, when the MSCI has a down month, its average return is minus 3.27%. In those same months, our average return is 2.04%. So in down months, we typically do pretty well. I just want to now have a look at lessons learned and have a look at the performance, bit of a summary from 2020. I think it's really important particularly, well, I can say we found it really important to manage 2020 to consider what happened in earlier crises. And really, I think what we learned from earlier crises as investors was what helped us in 2020. So let's go back, first of all, to the tech collapse in 2000. Global equity markets fell around 50%, and the Arnott Opportunities Strategy returned in excess of 100%. I mentioned earlier, I'll stress again, in those early years, we were using higher leverage than we use now, and we wouldn't be able to achieve that again. But the point is, we achieved positive results when the market had a really, really nasty fall. The collapse in the tech boom was very different to what's happened to other crises. We had plenty of time to run short positions in overvalued companies. And in many ways, it was more of a, if there is a typical bear market, where overvalued companies see compressions in valuations and they see earnings downgrades. There was limited intervention by central banks. In fact, they were tightening at the time, so you could argue they exacerbated the fall. If we then go to the global financial crisis of 2008, it was a very different situation. However, global equity markets fell, coincidentally, by around 50%, about the same as 2001 in a shorter period, though, and the Arnott Opportunities Strategy returned 1.62% positive. We were running close to $1 billion at that time, so I think it was no mean feat to weather 2008 unscathed. There was very little time to prepare a portfolio in 2008, unlike 2001. And once the housing bubble, US housing bubble burst, the market fell away very, very quickly. The use of index futures during 2008 was crucial to us navigating the market drawdown without losses, because we didn't really have time to get out of all the portfolio positions. What did happen in 2008 was the significant intervention in the financial system by the Fed and other central banks. And unless you've been involved in Japanese markets, which we had, you really hadn't seen this magnitude of intervention before. So that, I think, lays the foundations for what we looked for going into 2020. But just before we get to that, I just want to graphically look at what happens during these big markets fall, just to remind us the destruction of wealth that can happen. In 2000, we invested in collectively as investors of the equity markets, saw our wealth halve if you're invested in the equity market. It then took from 2002 until 2007 to get back to where it was in 2000, and it then promptly fell again by 50% and took till around 2014 to get back to the highs again. Now, during that whole period, we virtually had no drawdown, which again is just critical to what we're trying to achieve. 2020 has been a bit more interesting, so why don't we get to that now and talk about it? We are different. We outperform during periods of market weakness. That's certainly implicitly in what we're trying to achieve. For the first quarter of 2020, we achieved positive performance of 20 basis points versus the MSCI World Index Q1 performance negative 21.44%. Specifically in March, we returned positive 7.77 versus the MSCI World Index, which declined by 13.47. How do we achieve that? As a thematic investor, we scour the world looking for interesting opportunities. Some of those opportunities and themes are very specific, and some of them are related to where we have to study what's going on in countries, where we have to study what's going on by central banks, and that keeps us alert to risks. In April in 2019, we were actually having a look at an interesting theme, which is the spread of African swine fever throughout China, which looked at one stage like it was going to decimate half the pig herd in China, which is really important because the Chinese eat a lot of pork. We explored that theme probably for about 3 months. We put on some positions, both long and short, beneficiaries and those that we felt might get hurt. We didn't really make any money out of it and we took it off. But I mention that story because looking for that sort of theme made it easy for us in January of 2020 to pick up on the early spread of COVID, and we were really concerned about it. We actually put on a lot of shorts in January 2020, which we were stopped out of, but it certainly just gives you a bit of an insight out of what we're thinking about. We're constantly on the lookout because being a natural thematic investor, you stumble across these really interesting risks. So what we did was we saw the risk, we positioned the portfolio accordingly. We felt it was going to be a financial solvency risk. Not only did we short index, but we shorted companies that were going to suffer, those that are high leverage, either through balance sheet leverage or through operational leverage, through travel industries, which was specifically affected by it, and also financial players, including banks. Going back to the previous crises, we were watching the Fed and other central banks and politicians keenly in this crisis to see how they would respond. Both the magnitude and size with which the Fed responded in March saw us very, very concerned that actually, or not so much concerned, but certainly switch our view that we were going to have a solvency crisis. It was really a bailout by the Fed for all. And as a result of that, we swiftly lifted hedges and were able to achieve pretty good performance in April of 7.95%. That saw us finish the year 28.38 versus the MSCI World Index of 14.06%. And I just highlight this chart over here, right? These are the numbers I spoke about before. Our average return in months where the MSCI is down, in which its average return is minus 3.27. Ours since 2013 have been positive 2.04, and in 2020 that was exacerbated with a really positive number against a really negative MSCI number. Just going to have a quick review of our process. There's a lot of slides in this deck. We're not going to run through them all, but it is just worth reviewing, I think, very quickly how we go about our business and how we go about our workflow of finding, researching and investing in ideas. We have a pretty simple process. We scour the world looking for asymmetric themes. And once we find those themes, then we dig deep in those themes to find the best asymmetric payoff within them, the best stocks to express that idea. Those themes and the names within those themes typically endure for a 2 to 5 year period. But now this is where perhaps we're a little bit different to a long-term investor. The third part of our process is to pay particular attention to catalysts that are going to take place along that journey of owning that theme for 5 years. And as those catalysts come and go and shorter market cycles present better risk opportunities or worse risk opportunities in that theme, then you'll see us increase and decrease our position size to that theme. So what we are trading investors. We stick to themes for a really long period of time. The name turnover in the portfolio is very low, but we do have very high turnover because we will increase and decrease the weighting of those positions. I'm not going to spend a lot of time talking about the detail of the process any more than that. I now want to move to 2021 and talk about where we see macro risks and opportunities. So 2021, on face value, 2021 has all the hallmarks of everything we love in the equity market. We've got potentially very high growth, up to 6% in the US, combined with low rates forever. Well, not quite, but the Fed's told us they're going to hold rates low, and a lot of other central banks have said that as well. And very, very importantly, the third component is that the first two components are combined with enormous fiscal stimulus. In fact, I don't think we in the markets have ever seen these three ingredients being delivered all at once to the markets. Complete Goldilocks environment, which should by rights deliver a phenomenal market return. And not surprisingly, everybody feels happy about that situation. This is a This is a combination chart, which only goes back to about 87, but clearly everyone is very, very happy about the market situation. Importantly, this creates a major dilemma for the sensible investor. This current market has all the hallmarks of a bubble. It's got extreme valuation, it's got extreme price momentum, it's got massive issuance, highly speculative investor behavior. And, you know, make no mistake about it, every career incentive, every individual human psychological fault is going to work towards sucking us all in. And moreover, the returns just prior to bubbles ending can be so large that there's always very good reasons to be long just prior to the bubble bursting. The problem is that returns after the bubble bursts can be just as spectacularly negative as we cast our mind back in history earlier, we've already seen, and can have, you know, untold damaging effects on our portfolios. And I think positioning a portfolio to capture outperformance prior to the bubble bursting, but avoiding the worst pain of a major bubble breaking is honestly the most difficult part. And that is what's going to make investing from here forward, whether it's 21 or at what point, you know, we reach the end of this cycle, it's going to be very challenging. And with a hat tip to Jeremy Grantham, and he writes a great article on this, Waiting for the Last Dance. If you want to read it, I suggest you do. You know, make no mistake about it, for the majority of us all today, this could well be the most important event of our investing lives. So how do we take all that in context? Really good environment, but everyone's euphorically happy and the market's got conditions of a bubble. Well, the first thing I would stress is we have no ability to forecast where markets are going, and we don't try and do it. I don't know who can do it. We certainly can't do it. I think it's folly to attempt to predict macro outcomes. What we do spend a lot of time thinking about is we try and think about what is priced by the market and what are the consequences if consensus doesn't play out. That's not so hard to figure out. We see in 21 4 macro surprises that are not priced, and I would stress are pretty low risk, but that's why you need to keep an eye on them. The first is the Fed becoming more hawkish. Looks very unlikely at this stage. We will listen to any Fed governor talking, we will listen to any commentator around the Fed, and we will be an avid Fed watcher this year just to keep an eye on that. The second point is inflation. Look, there's been a fair bit written about inflation. Whether inflation comes or not is not so important. The Fed has told us that they're going to be relaxed about inflation going above 2%. They haven't even told us what that is. Is that 1 month? Is that 1 year? We don't have any idea. I think what's really important is not so much whether inflation comes, it's whether the market thinks inflation is going to come. Importantly, coming back to these 3 ingredients that we have in the marketplace, these 3 ingredients coming all at once together certainly have the possibility to cause inflation. So I definitely think it is a tail risk that we will be watching. The other thing that could happen is you might find that, you know, we have high growth, kind of containment of inflation, and then we get acceleration of inflation later on. I'm just saying that's a scenario that's worth considering because it would definitely surprise and upset the market. Investor sentiment changing. You know, this is undoubtedly really, really important. We spend a lot of time thinking about what percentage of any individual stock, what percentage of any individual market as a percentage of turnover is the price setter. You know, if we think about this in raw terms, when we turn up to buy a house, if somebody wants that house, they're going to buy it, and that one person will set the price. And you know, and when we talk about assets being bought by tenders, you know, we've all heard of crazy situations where someone may, you know, end up bidding 20% above the next bidder because they want it. and that's where they price it. Listed markets tend to be more rational, but we would say in our experience that you get 7% of market turnover or an individual market, individual stock turnover, it probably sets the price for where that transaction takes place at any one point in time. And I think it's fair to say that right now, retail is potentially setting the price. This is much more applicable in the US, but I would say that retail is probably setting the price of what we're all paying for a number of names, and therefore in aggregate, a number of indices at the moment. And if that aggregate buyer were to overnight disappear, then the step down in where the next buyer is likely to be is probably significantly lower than where we are now. And we're seeing crazy things like short covering in GameStop. It's sort of gone from $6 to 340. We're reading a lot now about how this is a new environment. So, I don't want to sound like someone with grey hair, but I just want to cast our mind book. This is a great book. You should all read this. This is The Money Miners, written by Trevor Sykes, and it's and I'll quote from the back. Until September 1969, Poseidon was a name known only to a handful of investors. Then, in the space of 4 months, the stock rocketed from 80 cents to $280 a share and pushed the speculative share market sky high. All of a sudden, thousands of ordinary Australians who had never seen a mine or even a stock exchange were gambling in the wildest stock market boom the nation had ever seen. Millions of dollars were lost and won in a matter of hours. Sadly, just about everyone lost in the end. I could also grab another great book, Irrational, we see it there, Irrational Exuberance. It was written before the 2000 fall. And I quote from the back, if the stock market collapses and doesn't recover for many years, this was written before the crash, don't say you weren't warned. In this bold and thoughtful volume, Robert Shiller, a respected US expert on market volatility, offers a sobering interpretation of recent stock market highs. I mean, there lies the dilemma that I point out before. We are definitely have ingredients of a bubble, but we also have more monetary and fiscal stimulus than we've ever seen before, which will probably support markets for a long period of time. And I think that what I want to stress is that we're not going to deviate from what we do. We're going to continue to find sound asymmetric ideas. We're going to continue to invest on the long side with some really good ideas. And we're going to remain prudent on macro risks and opportunities. What are we going to do on the short side? Well, shorts are bloody difficult now. So I'm going to hand over to Yianni to cover exactly what we're trying to do about our shorts.
Yeah, thanks, Kenny. So we thought it would be pertinent to discuss what our thoughts are around short selling in the current environment and how we're approaching the short side of the portfolio, especially when you consider the events that have transpired in the recent week with the short squeeze in GameStop and a variety of other retail names in the US. So the tidal wave of liquidity that has been flooding financial markets since March of 2020 has made the prospect of short selling a perilous task. So typically at Arnott, we seek to short sell equities that display one or both of the following characteristics. These are companies that have accounting shenanigans and corporate governance irregularities, and/or are concept stocks with overhyped equity stories. So with equity risk premiums shrinking to historic lows, these categories of equities have seen a rapid ascent in their share prices. Seemingly, market participants have thrown caution to the wind, throwing rigorous investment analysis out the window with the hope of investing in the next big thing, irrespective of these companies' underlying fundamentals. So as long as the quality of the investment narrative is high, fundamentals for the time being are largely irrelevant. So given this backdrop, throughout 2020, we made the active decision to reduce the size and quantity of single stock shorts in the portfolio, as it was clear to us at Arnott that the music was still playing, and very loudly at that. So at Arnott, Our process firmly ensures that we are not drinking the Kool-Aid and dancing the night away by owning the previously mentioned categories of equities with no fundamental grounding for our investment in these names. So this does not mean that we have ignored this part of the market and have given up on our traditional short selling process. In fact, it is quite to the contrary and the exact opposite. We believe this part of the market will be a rich vein of alpha on the short side in the coming years, and are stepping up our research into areas that we consider to be bubble-like in nature. We're actively looking for signs that the party is in fact over. So in doing this, we're not trying to pick the top, but we are merely looking for a point when we should begin to meaningfully add to our portfolio short exposure. So I'll leave it there, and now I'll move on to some of our investment themes for 2021. So I'll kick it off by discussing our Connecting the Future theme. Our Connecting the Future theme is heavily focused on 5G wireless technology. We see 5G as a transformational technology that delivers data faster, more efficiently, and with greater predictability than the prior 4G technology. This increase in the speed of data transmission is set to drive an explosion in the Internet of Things. Ericsson is forecasting that over the next 5 years, there'll be a 350% increase in cellular connections, resulting in a tidal wave of data demand. The primary driver of this explosion in the Internet of Things is 5G. It is the connective tissue that will enable the technologies of the future that have previously been starry-eyed concepts come to fruition. So for technologies and concepts like autonomous vehicles, robotic surgery, smart cities, and robotic factories, milliseconds matter, and the deployment of 5G wireless technology enables these products to come to market, developing the industries of tomorrow. So given the industrial benefits of 5G wireless technology, we're of the belief that this upgrade cycle will drive enormous productivity gains for industrial businesses, seeing this cycle differ greatly from the prior 2G to 4G cycles. So with this view, we believe the telecommunication companies and hardware providers will capture part of these productivity gains as they transition from not only operators, but also to becoming solution providers, resulting in significantly more profitable companies, driving enhanced ROIC from their existing assets. So to illustrate how we identify single stock asymmetry within a theme, let me talk you through Telstra and our investment thesis in the name. However, before I do this, let me say that 2020 was a tough year for our investment in Telstra. In typical Arnott Capital style, we were early. So as we enter 2021, Telstra is one of our highest conviction names in the portfolio. We see the headwinds of 2020 turning into tailwinds, driving significant outperformance in the name. So Telstra is Australia's largest telco operator with a greater than 50% market share of mobile and broadband connections. The reason why we like Telstra is simple. We see multiple upside catalysts, a share price underpinned by quality infrastructure assets, and a market perception that views Telstra as a boring, low return business that has done nothing for the past 4 years but destroy shareholder value. Well, look, maybe Telstra is a little boring and has been under pressure in recent history, but this is a classic Arnott Capital asymmetrical opportunity, an asset backing that limits your downside with a call option on 5G technology to reinvigorate the industry. So Telstra currently owns the vast majority of their infrastructure assets, being telco towers, data centers, cables, ducts, and pipes, which they've separated into a standalone business unit called InfraCo, with the sole purpose of driving enhanced returns from these quality assets. So we believe InfraCo is worth around $3 a share, providing a high quality asset backing to underpin Telstra's current share price. And you have a management team that is presently in the process of seeking to monetize these assets, which means for us as shareholders in Telstra, we see increased returns in the coming years via the way of dividends and share buybacks. So in addition to this, the Australian mobile industry has gone through 4 very tough years as the challengers consistently lowered pricing in an attempt to take share off the incumbent. So after significant value destruction in the industry, we are now seeing pricing hold at a point in time where Telstra is rolling out their 5G service offering, which our research suggests that they are at least 12 to 24 months ahead of their competitors, giving them a huge advantage and an ability to gain market share at a premium price point, driving enhanced profit outcomes for the company. So looking at Korea as the guinea pig, we're of the belief that the 5G rollout in Australia will result in industry pricing finally trending up. 5G provides a superior consumer experience, which early data points suggest consumers are unsurprisingly willing to pay more for. So we see no reason why Australia will not replicate the pattern of Korea, arresting declines in industry pricing. And lastly, but most important, we believe Telstra can become a solution provider, not just an operator. Currently, the enterprise solutions business is around 14% of revenues, but with the upcoming explosion in the Internet of Things, we see this business unit growing alongside the emergence of this new industry, as enterprises seek out innovative solutions for how 5G can be utilised within their own businesses. So I'll leave it there on our once boring but now exciting Telstra, and I'm going to move on to another theme within the portfolio and explain how we look to find opportunities within an early stage secular growth theme. So the theme I'm going to talk about is content anywhere, anytime. So over the next decade, we believe excess equity returns will be generated from owning the companies that focus on creating and producing content that consumers want to watch, play, read, or listen to. So from 2010 to present, the platform companies such as Amazon, Facebook, Google, and Apple that are now intertwined as part of our everyday lives have not only grown to be truly phenomenal businesses, but have also made fantastic investments, with their equity values appreciating by over 26% per annum since 2010. These companies have succeeded with a core focus of engaging us, the consumers, on their platform. So as we go forward, we do not see this strategy changing in the slightest. Instead, we see this intensifying as they seek to become a part of every facet of our lives. They are flush with cash and are using their treasure troves to compete intensely with one another for a larger share of our wallets and also of our time. This has seen them create multiple verticals, such as Amazon Music, Apple TV, and Google Play, just to name a few. The core of these verticals centers on offering engaging content to drive more time by us, the consumer, on their platform. So truly engaging content that we can watch, play, listen to, and remain fully engaged with is, in our opinion, not an abundant resource, but exists in limited supply. So as I mentioned previously, there are very large, very wealthy buyers of content, laser focused on retaining the dominance of their platforms. So in our view, this is the perfect setup for a sustained re-rating in the value of companies that create, own rights to, and produce content across multiple verticals, such as television, news, computer games, and music. So to highlight how we're investing in this theme, I'm going to quickly run through one of our investments that we've made, and that's in the music industry. We currently own 2 of the 3 top record labels, being Warner Music Group and Universal Music Group, through their majority owner being Vivendi. So what attracted us to the music industry can broadly be simplified into one image, and that image centers around industry structure. To the left-hand side of the equation, you see the demand side. You have an increasing number of music streaming platforms being created to take advantage of the structural tailwinds that exist in the industry. In addition to this, you have the major platform companies all stepping up their competition for our ears. I'm sure every one of you on this call has received a very attractive offer recently to join either Amazon Music, Apple Music, or YouTube Music. Well, look, surprise, surprise, but the core ingredient for a music streaming platform to be successful is indeed recorded music. So looking at this quite simplistically, the demand for recorded music is increasing at an accelerating rate. So now we move on to the supply side of the equation with a focus on the record labels. The top 3 record labels control just shy of 70% of the recorded music industry and hold the rights to a high proportion of the hit artists we know and love. So if you're a music streaming platform, you have no other option but to negotiate with and sign deals with all 3 of these record labels. The reason being quite simply, as a consumer, I couldn't imagine paying for a music streaming platform if it only had one of my favorite artists, but was missing the rest. A music streaming platform needs to have a wide variety of music, which when you think about it, that gives the record labels a fair amount of power when they sit down to negotiate a deal with these platform streaming companies. But where we believe the real moat lies is within the record labels' back catalogues. Over 60% of all music streamed is older than 18 months old. So the feat of a big tech company trying to poach present hit artists and create their own label would be fruitless. Not only do I want to listen to today's fresh hits, but I also want to listen to the oldies. So in our opinion, this sets the stage for a large demand-supply imbalance. You have demand increasing at an accelerating rate and supply controlled by the top 3 record labels. To us, this signals that there is a multi-year appreciation in the value of these companies' rich back catalogues of music ahead. So I'll leave it there and I'll hand it over to Kenny to talk about our uranium thesis.
Thanks, Yianni. So our uranium is a classic, probably a classic Arnott find. We go scouring in commodities, looking for where we can find situations where you see a supply and demand imbalance taking place. Sorry, guys. Where you can see a supply and demand imbalance taking place. And that's, sorry, guys. We go scouring for these things where you can see a supply and demand imbalance taking place. I think I'm addicted to my Bloomberg screen. I'm not, it's just jumping up and down. And we saw this in iron ore in the early 2000s, and uranium was one of these classic situations where you watch for an inflection point where you're going to move from a point of oversupply to undersupply. Normally the price behavior around that period is anything less than orderly. And what we see in the uranium situation going forward is both pressure from increased demand and reduced supply. On the increased demand, we have China is really, really important on a long dated perspective. China is typically buying 7 years forward. China is making plans for the next 50 to 100 years. And nuclear power production is going to be an integral part of the uranium story globally because it's an integral part of the Chinese power production situation. Bringing something a little bit closer to the current point in demand, nuclear is the only way to generate green baseload power. And this has become really, really important as we've seen, really, really strong shifts in ESG, and associated with that, we've seen a massive shift to both wind and solar production of green power, which neither of those can reliably generate baseload power. So uranium could well be the baseload power that fills the gap in conjunction with those two power sources. Third demand factor is that for the first time since the 70s, we're actually seeing new builds at a significant number take place. And we're also seeing life extensions of existing nuclear power plants, which largely are a very large concrete infrastructure with a lot of technology which is upgraded within the plant. So that is also seeing demand increase. And fourthly, over the last 3 or 4 years, we've had a lot of policy uncertainty, particularly policy uncertainty in the US, the Section 232 notice, and more recently the Russian suspension agreement have really resulted in creating a whole lot of uncertainty, particularly for the US domestic power producers, nuclear power producers. And as a result of that, their inventories have run down. They've been reluctant to go into the forward market and purchase. And we now flip that to the supply side. While this increasing demand profile, which we can see here, is happening, on the other side of that, we've got a really interesting situation which has developed largely a result of the market being in a bear market since Fukushima, which has seen prices fall from 170 odd down to 20 at the lows last year, the year before, and that has really restricted production. And in fact, the current supply and demand deficit is currently being met only by drawing inventory. And if we take that in the context of what has actually happened because of COVID production shutdowns in 2020, the two largest producers in the world, which is Gazprom and Cameco, are currently in the spot market, buying from the spot market to fulfill the deliveries which they have in their forward order book. And I just want to say that again, because I can't overstate the importance of the two largest producers of uranium globally are buying in the spot market to meet their forward order books. I mean, that is an absurd situation in any commodity market to be happening, and certainly is going to present and maintain a very tight situation. So that is our thesis. It's worth considering why now, what's going to happen to drive the price of uranium and the uranium producers up in 21. Well, there are a number of catalysts which are tied to the previous slide around the demand and supply situation. First of all, US and European nuclear utilities have begun the year with very low inventories. As I mentioned, the typical fuel cycle lasts 18 months. It's estimated that US utilities are probably down to one fuel cycle. You can't shut nuclear power plants down. You have to keep them running. And as a result of that, you have to maintain a fuel cycle worth of fuel rods. So, we're almost perilously low inventories at utilities. The second catalyst is that for the first time in several years, there are no geopolitical political overhangs, as I mentioned previously, particularly in the US, but also for the European utilities. Third one is interesting. We've already spoken about the fact that we're coming out of 2020 with massive growth expectations, and nuclear power being a supplier of power has been affected in 2020. The demand is not down as much as a variable like natural gas producers, but certainly is down. And so it's going to see a natural pickup as the economy picks up. The fourth point is that we're seeing the development of small modular reactors. Some of them fit virtually in a shipping container. It is still early days, but there is an enormous amount of money being spent on this technology. And it's very, very possible that we could see a whole ancillary benefit to the demand side through these small reactor build-out program. And the last one is that with the US elections, with the US changing, we've seen decarbonisation goals that certainly weren't with the last regime, and they're going to lead to reduced use of coal and natural gas, reduce electricity, which is cutting support for what has been nuclear energy's cheaper competitors. So certainly all the ingredients seen there, and we think it's a really interesting story. We've got about 20% of the fund in it, so certainly got very, very high exposure to this theme. I'm going to wind it up now, and I'm going to just hand it back to Yianni, who's going to grab a couple of questions before we close off the presentation.
Yeah, thanks, Kenny. So we had a few questions emailed in from people beforehand. So I'll kick off with the first one. How did you manage to make money in March when equity markets broadly collapsed? Yeah, look, we did cover this in the presentation. Look, the first thing I want to stress is, we're asymmetric investors. To be an asymmetric investor, you've got to spend time thinking about downside, but it doesn't mean we're going to be immune from market falls. I mean, over a very long period of time, we've done an exceptional job of managing market drawdowns, but we can't obviously guarantee it's going to happen in the future. How do we do it in 20? Well, the critical thing as a thematic investor, we are constantly
scouring the world for interesting opportunities, and we just can't help but stumble across issues as they arise. And, you know, as we sit here right now, we're very interested in the situation going on with Tether. Now, some of you may or may not know what's going on with Tether. Tether appears to be an interesting situation in the US, which is a crypto backed by US dollars, which has then gone and been a large buyer in the Bitcoin market. Now, look, I just mentioned that because that may be important for the market or may not, but it's something that we spend a lot of time looking at. You know, when we see retail participation very strong, we pay attention to that and we try and understand what's going on, whether there's, you know, an investment opportunity or whether there's you know, where there's a risk for the overall market. When we're studying the uranium market, we have to understand, you know, uranium market, whether you're a private operator or a government operator, of which there are many in the uranium space, you can't help but, and you have to have a view on what is going on with geopolitical tensions around the world. We have to have a view on what's going on in the US political landscape, the European landscape, what is going on with Russia and what is going on with China. So, you know, again, just by being a natural thematic investor, we are naturally watching those sort of risks. As I mentioned, when we went through March, what actually happened was we've been investing in Asia for a long time. So I think anyone who's been through SARS was a little bit sensitive to these viruses and how they affect the market. And we were certainly very, very sensitive to it in January. And as per normal, we're a little bit early and you know, got stopped out on those hedges in January, but it left us in very good stead, and we took a lot of care to prepare the portfolio for what we felt was going to be, you know, a very, very large solvency risk for the market. As I mentioned, it didn't pan out that way because the Fed got involved.
So I'll move on to the next one. What indicators did you use to increase your net exposure throughout March and April? What indicators are you currently looking for? I guess you already mentioned Tether, in the current environment to bring down your exposure.
So I wanted to cast our mind back to the 2000 crisis and the 2008 crisis, and I could go back before Arnott, you know, but in my trading career to the Asian crisis of 97, and I could go back to the early 90s when I was trading cotton. We've learned a lot through our career, and we haven't learned it all easily. Some of it we've learned painfully. You know, we actually came out of 2008 and probably sat on our hands a bit and didn't take enough risk. So what we did in 2020 was we felt, if it's going to be a solvency risk, the most important thing to watch is someone that may alleviate solvency risk. So we were avid Fed watchers, and that was what caused us to significantly and quite swiftly change our portfolio into April. You know, what are we looking at now? It's bloody challenging right now because we are trying to outperform in markets and stocks which are going completely bananas, with absolutely no regard for valuation, by a marginal buyer, which has no regard for valuation. And as I mentioned, we have all the hallmarks of a bubble, but if you short these things too early, you know, and we must remember what happened in '99. There were some phenomenal investors, Julian Robertson, Stan Druckenmiller. These guys, by their own admission, got into a bit of trouble shorting, and then in actual fact turning around and going long. It's very, very tough to maintain discipline at these times. What are we watching right now? Well, we are watching. I think the most important thing is that the Fed drives global markets. What's the Fed doing? Number one. What is going on from a market participant point of view? What is going on from a valuation perspective? That won't see the turning point, but it's really important to keep an eye on it. And then, you know, what sort of political landscape are we in? Obviously, coming out of COVID is very important right now. I mean, one thing I would stress is that the Northern Hemisphere flu season is now well past its peak, at a point where vaccine is being rolled out massively, at a point where monetary stimulus which is enormous at a point where we have massive fiscal stimulus going on. All those things are going to provide enormous support for the market. So, notwithstanding the fact that we do have a lot of ingredients for the bubble, for a bubble-like environment, we also have very unusual situation of a lot of support for the market. So we're taking all those things into account. But most importantly, we just like watching really weird little things like Tether, just to see if that, or like GameStop, just to see if these things actually are catalysts. You can always look back. You could look back on 87, you could look back on 2000, and you could see that catalyst in retrospect. We try and, it was Bear Stearns, it was Enron, it was German GDP in 87. We're sort of always constantly just trying to keep an eye out for those quirky things which don't mean much on the day today, but they may be the things we look back at that, that was the straw that broke the camel's back.
So I guess that's a great follow on to the next question that we have is, so what tail risks and events and surprises do you think could happen in 2021, and how do you prepare for them?
Yeah, I guess we're sort of covering the ground that we've covered, but these are the tail risks that we see. I mean, we're accumulating knowledge and making sensible and some unsensible decisions on a daily basis. And this list may change next week, but right now this is what we see right here today. That we're watching the Fed becoming more hawkish. We're watching the risk of inflation. We're watching investor sentiment changing, and what is priced in the market. Look, one thing we haven't spoken about during this conversation, I think, is worth spending just a small time on. A balanced investor globally will typically have a portion of their portfolio in sovereign bonds, in government bonds, and that may be 2%, that may be 30%. And over a very, very, very long period of time, that's proven to be a hedge against their equity exposure, which is aimed at producing higher returns than that bond exposure, which is much less risky. If you are investing right now in German bonds at minus 50 bips, actually even Greek bonds are trading negatively. I mean, help me, what sort of market are we in? I think about that as an asymmetric investor, and that just feels like selling puts to me. And I think that we as global investors are figuring that out, that actually investing in bonds is no longer a hedge against your equity book. And that is, by definition, forcing people into equities. But it then must surely be creating this very lopsided risk situation that there is not a risk, there is not a hedge to go to of the magnitude of government bond market in the event that we lose faith in the fiat money system. So it's probably not a risk for this year, and I don't know when that will unfold, but it's just worth keeping at the back of our minds.
So look, we're a tick over 50 minutes here. We'll probably wrap it up there. Kenny, any final remarks?
No, that's it. I'd like to thank everyone for joining us. There will be a replay of this webinar, and we will be sending out the presentation and try and cover off on any questions that we didn't get to. Thanks very much, everyone, for all your time.
Thanks, guys. Really appreciate it.